In 1929, margin loans collapsed overnight. In 2008, a single bank's failure sent panic through the entire financial system. Today, Nvidia's explosive rise is built on the same patterns: rampant speculation, surging leverage, and mounting euphoria, just as stress builds beneath the surface. Are we watching history repeat, or is this rally truly different? The past suggests the answer may arrive far sooner than anyone expects. By the late 1920s, Wall Street had become a magnet for borrowed money. Margin accounts let investors buy stocks with just a fraction down, sometimes as little as 10%, leaving the rest financed by call loans from banks and brokers. In 1929, margin debt ballooned to levels never seen before, reaching as much as 9.6% of the nation's GDP. The logic seemed simple. As long as prices kept rising, everyone could borrow, buy, and profit. But the system depended on constant confidence and easy credit. That spring, the Federal Reserve grew uneasy. Worried about runaway speculation, it began to tighten credit, quietly raising the cost of borrowing and pressuring banks to rein in lending. The effect rippled through the system. Brokers, suddenly facing higher rates and stricter rules, started calling in loans. Investors who had built fortunes on margin found themselves squeezed. If a stock's price dipped even slightly, the broker could demand more collateral at a moment's notice or force the sale of shares at fire sale prices. By September, the amount of margin loans to so-called constrained investors stood at $17.7 billion. When stocks faltered in October, the pressure became unbearable. Forced liquidations swept the market, driving prices even lower and triggering more margin calls in a vicious cycle. Panicked crowds gathered outside banks, desperate to salvage what they could. In just a few months, margin lending collapsed from its peak, and the easy money that fueled the boom vanished. The cascade of forced selling and vanishing liquidity set the template for every leverage-driven crash that would follow. By the early 2000s, Wall Street had moved far beyond the visible leverage of margin loans. Risk was now bundled, sliced, and sold in layers so complex that even industry veterans struggled to trace the connections. The housing market, once a slow and steady corner of American finance, became the engine for this new wave of speculation. Subprime mortgages, loans made to borrowers with shaky finances, were packaged into mortgage-backed securities, then repackaged into collateralized debt obligations, or CDOS. By 2007, more than $1.2 trillion in subprime mortgages had been originated, and over $500 billion in CDOS flooded the global financial system. On the surface, these instruments promised safety through diversification. In reality, they hid enormous risk. Banks like Lehman Brothers relied on short-term repo funding, borrowing over $200 billion each day to keep operations afloat. Off-balance sheet maneuvers, such as Repo 105, allowed Lehman's to temporarily move up to $50 billion in securities out of sight, masking true leverage from both investors and regulators. Meanwhile, the notional value of Lehman's derivatives book soared past $35 trillion, linking it to thousands of counterparties around the world. When housing prices stopped rising and borrowers began to default, the web unraveled at breathtaking speed. In September 2008, Lehman's funding sources evaporated almost overnight. On September 15, 2008, Lehman filed for bankruptcy, the largest in U.S. history, with $639 billion in assets and $619 billion in debt. Within hours, the tri-party repo market seized, commercial paper issuance collapsed, and interbank lending rates spiked. Panic spread as money market funds saw over $120 billion in outflows in a single day. The global credit system froze, exposed for all to see how much risk had been lurking in the shadows, hidden by the very instruments designed to disperse it. Nvidia's stock chart reads like a fever dream. In less than a year, shares have surged 28%, reaching a recent high of $207.04 on October 29th. The company's rise is not just about numbers. It is about the story investors want to believe. Headlines everywhere declare the dawn of an AI revolution, and Nvidia's CEO Jensen Huang is cast as the architect of a new digital age. Each quarterly earnings call becomes a spectacle, with analysts hanging on every word, searching for any hint that the growth might slow. Social media lights up with posts hailing Nvidia as the next trillion-dollar winner, while retail investors pile in, convinced that missing out would be a mistake. News anchors and finance influencers echo the same excitement, repeating phrases like unprecedented demand and limitless potential. The narrative is simple. AI is unstoppable, and Nvidia is at the center of it all. As price targets climb and optimism grows louder, the gap between the market's euphoria and the realities of business fundamentals widens. The mood is electric, but the question lingers. How much longer can this momentum last before gravity returns? A handful of companies now hold the fate of the entire market in their hands. The top 10 stocks account for nearly 39% of the S&P 500 total value, a concentration not seen even at the height of the dot-com bubble. Nvidia alone recently made up almost 10% of the index, surpassing the largest single stock weights ever recorded. Microsoft and Apple, alongside Nvidia, collectively represent over a fifth of the index's entire market cap. This level of dependence means that a stumble by any one of these giants can ripple through millions of portfolios, retirement funds, and passive investment vehicles. Valuation metrics only deepen the concern. Nvidia trades at a trailing price-to-earnings ratio above 46, with a price-to-sales multiple exceeding 16, figures that recall the wildest days of 2000. Forward projections assume relentless growth, leaving little room for disappointment. Even among its mega-cap peers, these numbers stand out. Microsoft and Apple hover near 27 to 29 times earnings, but Nvidia's multiples are in a league of their own. When so much capital is concentrated in so few names, the market's resilience weakens. A single earnings miss, regulatory shock, or shift in sentiment can set off waves of selling, amplified by the sheer scale of index-linked funds and derivative bets. The system's apparent strength rests on an unusually narrow base, making it more fragile than most investors realize. Margin debt is now rising at a pace that outstrips the market itself. Over the last year, borrowed money used to buy stocks jumped 38.5%, while the S&P 500 gained only 17.6%. This gap, where leverage grows more than twice as fast as the market, has appeared just before every major modern crash. The same divergence showed up ahead of 1929, in the dot-com peak of 2000, and again before the collapse of 2008. It is a warning that investor returns are being propped up not by healthy profits or real business growth, but by a swelling tide of borrowed cash. Beneath the surface, new channels of risk have emerged. Options trading volumes have exploded, with retail investors pouring into zero-day contracts that can swing portfolios wildly in a single afternoon. Structured products, many linked to AI and tech stocks, quietly multiply the impact of every market move. These instruments create hidden leverage, risk that does not show up on traditional balance sheets, but can trigger forced selling if prices slip. The crowd is still cheering, but the numbers suggest a system growing more fragile by the day. When leverage outruns fundamentals, history shows the outcome is rarely gentle. Liquidity does not disappear in slow motion. It vanishes all at once, pulled out from under the market by a series of invisible triggers. In today's financial system, the first crack often appears in the repo market, where banks and brokers borrow trillions overnight to fund positions. This is a crisis of liquidity. A sudden rise in repo rates or a pullback from cash lenders can force institutions to scramble for dollars, selling whatever assets they can to meet obligations. The central clearinghouses then demand extra collateral as prices drop, issuing variation margin calls that ripple out in real time. Each forced sale pushes prices lower, which triggers more margin calls in a feedback loop. The pressure on margin is relentless. The chain reaction does not stop with banks and hedge funds. When options and structured product exposures spike, retail investors face margin calls too, sometimes with only minutes to respond. Index funds and ETFs programmed to rebalance instantly amplify every move. The result is a cascade. Selling begets more selling, liquidity dries up, and even the safest assets become hard to trade. The market can tip into a cascade in a matter of hours. In these moments, the market's plumbing, repo, central clearinghouses, and margin accounts turn from background machinery into the main character, dictating who gets out and who is trapped. What starts as a single missed margin call can, in hours, become a global rush for cash with exits blocked and prices in freefall. The plumbing of the system decides who survives. Today, over 30% of the gains in the S&P 500 hinge on just a handful of tech stocks. As history echoes through every chart, the real risk is not missing the next rally. It is ignoring the warning signs. Bubbles do not announce their end. Until they do, what happens next is up to us.